Something happened in January 2026 that has never happened in Bitcoin's entire 16-year history. Not in the 2018 crash. Not during the COVID wipeout in 2020. Not even when FTX collapsed and took half the market with it in 2022. For the first time ever, Bitcoin posted back-to-back monthly losses to start a calendar year. January down 10%, February down another 15%. 23% gone in 50 days, the worst opening stretch Bitcoin has ever recorded. And the people who moved first were not retail. They were the largest financial institutions on the planet, and they had been quietly walking out the door for weeks before most people even noticed. This is the story of what actually happened, what the data shows, and what it might mean for where Bitcoin goes from here. Go back to January 2024. That was when the SEC finally approved spot Bitcoin ETFs in the United States. It was treated as a historic moment. For the first time, everyday investors and massive institutions could buy Bitcoin through a regulated brokerage account. The money poured in immediately. BlackRock's iShares Bitcoin Trust, ticker IBIT, became one of the fastest growing ETFs in financial history. Within 12 months, cumulative inflows across the entire fund complex had surpassed $53 billion. $53 billion. The price responded exactly the way you would expect. Bitcoin hit $100,000 for the first time in late 2024. The narrative was clean and compelling. Institutions are in now. The ETF wrapper makes Bitcoin safe for pension funds and endowments. That narrative held through most of 2025. Then it did not. The cracks started appearing quietly in November 2025. ETF outflows began showing up in the weekly data, small at first, the kind of numbers that get explained away as normal profit-taking. Then December came and investors pulled a combined $4.57 billion out of spot Bitcoin ETFs in just 2 months. Analysts at the time called it year-end rebalancing, weak hands exiting. The story was that January would reset the trend. January brought more outflows. Then February brought more outflows on top of those. By 50 days in, spot Bitcoin ETFs had hemorrhaged nearly $4.5 billion. BlackRock's IBIT shed more than $2.1 billion. On January 29th alone, investors pulled $817 million in a single trading session, the largest since November. CryptoQuant analyst J.A. Martoon calculated that cumulative Bitcoin ETF outflows from their October all-time high had reached $8.3 billion. Here is the part that makes this more complicated than a simple panic story. The derivatives data did not look like panic. Futures open interest dropped 20%, but the price declines were orderly. This suggests controlled deleveraging rather than a structural breakdown. There is also a rotation story. On the same days Bitcoin was bleeding, Solana ETFs were seeing net inflows. Money was moving within crypto. Brevan Howard, one of the largest macro hedge funds, reduced its stake in BlackRock's ETF by roughly 85% in late 2025. That is not a retail investor making an emotional decision. That is a team of professional risk managers making a calculated choice. The gold market tells part of the story too. While Bitcoin ETFs were hemorrhaging capital, gold ETFs attracted $16 billion in inflows. When money goes to gold, it means buyers are moving to safety. A firming dollar and hawkish Fed signals were all present in early 2026. Now here's the historical context that makes this genuinely strange. Bitcoin had its halving in April 2024. Every previous halving has been followed by a dramatic price surge. Less new supply coming in, same or growing demand, price goes up. In 2016, Bitcoin went from 600 to 20,000. In 2020, it went from 9,000 to 60,000. We are now almost 2 years past the April 2024 halving. Bitcoin is at 67,000, nearly the same price it was during the halving. In every previous cycle, Bitcoin would have been 3 to 10 times higher. This failure to rally has never happened before in history. Macro conditions in 2026 are genuinely different. Those zero interest rate and money printing environments of 2021 do not exist right now. Bitcoin's price is also sitting at 2.88 standard deviations below its 200-day moving average. That is a level of statistical stress. The most honest read of what is happening right now is that nobody actually knows. The bears have a real case. Record searches for Bitcoin Zero tells you about retail sentiment, even if that often marks capitulation bottoms rather than declines. The bulls have a real case too. The selling has been orderly. Rotation suggests the money has not left the ecosystem. $53 billion in cumulative ETF inflows does not evaporate because of a 5-week outflow streak. Bitcoin is sitting at a technical inflection point in a symmetrical triangle pattern. Patterns like that tend to break sharply. The era of ETFs making Bitcoin safe and predictable and boring enough for pension funds has arrived. What nobody told you is that when institutions can exit cleanly through a regulated product, they do, and they do it fast. That is the actual story of what is happening to Bitcoin in 2026, a reckoning with what it actually means to be an institutional asset. Like and subscribe to get latest insights on crypto market. Thank you for watching.